Let me go across. We have, sticking with the financials, Chola Finance, and we have Arul Selvan, who is Chief Financial Officer at Chola Investment and Finance, joining us this morning. Mr. Selvan, great having you as always. Q4 disbursements were extremely strong. AUM growth was 21%. Give us the guidance for Q1 as well as FY27 full year, because the guidance of 20 to 25% growth for FY26 is achieved at the lower end of the band. Is FY27 looking stronger?
For FY27, we are retaining our earlier guidance, which is anywhere the AUM growth of around 20 to 23%. We'll continue to hold that, and I think we are confident of going there. For Q1, Q1 always is a slow quarter, so Q1 it will be slightly lower with regard to most of the businesses. But it may still be, at the lower end of the 20% growth number. But overall, we don't see too much of an aberration in what we have said so far.
Mr. Arul Selvan, can you take us through your growth strategy as well, and what would be the risks and as well as the levers that you foresee for FY27?
So the risk, as you all know, is with regard to the global scenario that is, yet to get resolved in its entirety. Well, there is a little bit of a slowdown in the escalation of war, but it remains unresolved, and fuel prices are set to go up even if the war is subsided to a large extent, primarily because many of the facilities by themselves have been either destroyed or non-commissioned. So there could be a large period of higher fuel prices. In India, while the fuel prices have been held, it is set to go up most probably after the election results come in. So if that goes up, it will create certain amount of slowdown with regard to new product purchases, as well as in the credit profile of the customers who are in our portfolio. However, we don't see that too much of a impact, primarily because most of the fuel prices will get passed down over the period of time.
And how should we think of the credit cost trajectory? There's plenty evolving in the global marketplace as well as domestically. What's the sense there like?
See, last year we closed the year with around 1.7, factoring in the 200 crores management overlay we put. Without that, it would be in the range of around 1.6. Originally, we had been talking at the range of around 1.4 to 1.5 for FY27. We still hold that, subject to some, in case there is a severe escalation with regard to the in the global scenario. The other factor also is the possibility of a very stark El Nino impact. And if it is not severe, then I don't see that as a major
factor. Your net interest margins expanded by 40 basis to 8.4%. How sustainable is this going forward, and what is the trajectory of cost of funds going forward?
The NIM went up because we also had certain opportunities to do, a direct assignment deal of a slightly larger proportion. And also during the Q4, a lot of charges collection, etc., would be, at its best. So these two had helped in sort of scaling up the NIM in Q4. I think over a cycle, it should be, at the range of around 8%, subject to cost of funds movement. Cost of funds by itself is hardening a bit, but we need to see how it pans out as we move into the full year for FY27.
The other piece is cost to assets or cost to income, as one calls it. You've seen some improvement there as well. Further in terms of a lever, is this one of those that you'll rely on?
See, we try to hold our cost to income at similar levels. We measure it like cost to assets, and the cost to assets would be in the range of around 3 to 3.1%. on the average assets. In spite of our plans to bring in more branches under the gold loan portfolio, as well as scaling up the rest of the other new businesses which we have brought in over the last 2 years, we will try to hold the cost to assets at the same levels of 3 to 3.1% as we move into FY27.
On the return on asset side, you have been able to scale up the ROA to nearly 2.9% at the end of Q4. Do you see this trend improving going into FY27? And where can we see the final figure at the end of the financial year?
ROA guidance, pre-tax ROA should be in the range of around 3.5%. This is our target. While we have done around 3.2% for the 3.4%, 3.3%, for the full year and 3.8% for Q4. We will hold it at. We will try to improve it to 3.5%, primarily coming out of NCL and to some extent on the NIM side. Yes.
Great having you, and thank you so much for coming in and speaking with us, Mr. Selvan. We'll close the conversation here for today at least. What we'll do is to a very short break.